Our next panel, we were just chatting backstage, and I'm very excited to have this conversation because it's talking about a new asset class, and you can't often say that there's truly a novel and new asset class to look at investing in. So, and please don't boo me, but I'm going to read what's written. Next up is a conversation that will undoubtedly sparkle and dazzle. Our speakers will be discussing how investors can access the $1.2 trillion diamond industry as a truly new alternative asset class opportunity using blockchain. So please welcome to the stage Cormac Kinney, the founder and CEO of Diamond Standard, and backed by popular demand, Risk Reversal Media's co-founder and CNBC contributor, Guy Adami.
So thanks, everyone. So I got a chance to meet Cormac, and please sit down, a few months ago through iConnections, and not to bore the shit out of all you folks, but I was a commodities trader in a past life. So this sort of resonates with me. I think it's fascinating, and I think you'll find it interesting as well. But I also think there needs to be some context around this, because you just didn't stumble into the diamond world. So maybe share with the audience your background and sort of drill deep a little bit, because I think it lends itself to exactly where you've gotten now.
Yeah, I might be the one guy in the world that could have the background that brought this together. So my background first is computer science. I have 3 degrees from Carnegie Mellon. And starting at CMU, I launched my first software company when I was a sophomore, and it did optimization, and that ended up getting acquired by Oracle. And since then, I continued to launch companies. The big one was NeoVision, and I had backing from Intel and JP Morgan and Deutsche Bank. And we built over 100 trading systems. We had a kind of a modular system. And people may be familiar with heat maps. I also invented heat maps back in the 90s. So I spent a lot of time on trading floors, and that company ultimately was acquired by the Carlyle Group. And I spent so much time working with traders, I decided I want to do that too. But I had a really good idea, which was, again, from Carnegie Mellon, to use computational linguistics. And I built one of the first systems to read all the news and use that to quantify opinion. And there's a thread here, because diamonds are a lot like opinions, like about a company and sentiment. But that led me, when I built that first sentiment trading system, I ended up being the running quantitative equities stat arb for Paul Tudor Jones, and ran that through 2006 to 2008. And then I brought my team to Millennium, and I ran a large quant team at Millennium for several years, and ultimately they acquired it. But what pulled me into diamonds is my wife is a famous jewelry designer, and she had always complained about the diamond market, how every diamond's different, and therefore there was no price discovery. The friction of trading a diamond was immense, and because of that, institutional investors could never touch diamonds. And so the idea was simply, I want to use that quantitative approach, which was automated market making, statistical arbitrage, and optimization, to solve what I believe was a computer science problem, which is how to standardize diamonds.
You talked about heat maps before. No, but it's interesting. So around what time did you sort of, I don't want to say stumble, because that does not do it justice at all, but did you discover that? And there's a reason why I'm asking.
I invented heat maps in 1992. I coined that word. That word never existed. If you look up the trademark, it's Cormac Kinney heat maps. But 92, and then that was the foundation of NeoVision.
So when you watch CNBC now, you'll see exactly what you created on their broadcasts. I mean, they talk about heat maps, and to the extent that something's green, hot, cold, those types of things. I mean, that's something that you created effectively 30 years ago.
And that's been my whole career, is taking huge amounts of data and trying to find the consistent pattern.
So why I mention that, because you were clearly, in our world, typically early is wrong, but in your world, early is trend setting. And this is why I want to talk about the fact that you were so far ahead of the curve, and I think that's diamonds as an asset class is exactly that. So let's speak about diamonds as an asset class. And now there's a scene in Godfather 2, I don't know if there are any paisans out there, but in Godfather 2, they're sitting around a big table, they have that big gold phone that they pass around. Good news is none of those old dudes were going to be able to run out with it. So I would pass this around, but I'm actually concerned that somebody in the crowd is going to take off. But in your hand, I mean, what I'm holding up here, I mean, that's $55,000 worth of diamonds, and it has obviously, you know, the QR code on the back. So let's speak about exactly this and why you think, once again, you're ahead of the curve.
Well, the breakthrough is not that there's diamonds in here, but that these two bars are equal. That's the breakthrough. And all the bars are equal. Each bar contains a regulator-approved set of diamonds that all add up to equivalent carat weight, color, and clarity. So this is the spot commodity. This is mark to market. It's listed on Bloomberg. It's listed on S&P. But this is the foundation for unlocking diamonds as an investable asset because they're standard and mark to market every day.
It's fascinating. So this, at its core, it's a commodity play, but it's more than just a commodity play as well. Obviously there's a technology aspect to this as well. You've sort of married those two worlds. So there's an investment thesis behind it. Speak to that.
Yeah, it's interesting. You know, diamonds, everybody knows diamonds, right? And they've been valuable since the days of the pirates. You know, everyone is always, but it's always been for the wealthy. And, you know, in the 30s, De Beers made it much more consumer oriented. But diamonds are a $1.2 trillion asset class. That's the value of the above ground diamonds. 1.2 trillion, turns out that's more than all the silver, platinum, palladium, and rhodium combined. So it's second only to gold, but investors could never allocate to diamond because if you're a fund, you couldn't mark to market, you couldn't have liquidity, there's no price discovery. So we've unlocked this latent, neglected asset class for the first time, and the supply demand is actually very simple. They haven't discovered a new diamond mine in 20 years, and the supply is diminishing. So it's falling between 4% and 6% per year. But at the same time supply is falling, the demand is rising for diamond jewelry, especially in China, but also in the US. So globally, demand is rising, supply is falling, and now you have a troublemaker who's coming in from left field, and we're becoming one of the largest diamond buyers in the world, putting a lot of pressure on an already imbalanced market. So we're launching, right now we have spot market, we have approval for futures and options. The futures are listing on the CME. We've launched a fund, and we're right now developing a listed fund that altogether are going to allow investors to allocate to diamond so that diamonds catch up with palladium, for example.
Ron puts on an amazing conference. This is somewhat self-serving, but I was speaking to a couple people in the green room, and Lauren Wilkes said, oh, this is really interesting. I just read an article from The Atlantic in February of 1982 talking about the scarcity factor around diamonds and, you know, what it leads to and those types of things. 40 years later, you know, here we are, and it's becoming an asset class. So speak to, I mean, the challenges, I think, are pretty self-evident, but mining diamonds. I mean, what are your challenges, the challenges that you faced and basically have overcome, and the challenges you think you will face going forward?
Yeah, well, the first challenge was all the computer science. And it's actually a very significant number of breakthroughs. And that involved automated market making. We actually built a system that makes 16 million bids 3 times a day. And automatically, we don't have an opinion on the price of diamonds, for example. We simply bid. But we are the first market maker to bid on all diamonds. So that was a big breakthrough. There are a lot of technical challenges. But we decided from day one that we wanted to bring a regulator along. And so it took us 2 years, and it turned out to be the Bermuda Monetary Authority because the CFTC doesn't regulate spot commodities. They only regulate derivatives. So we got regulatory approval for this commodity. They oversee the diamond buying, the optimization, the offerings. We have to do KYC and AML. We're have an escrow client monies. So we're extremely regulated. We had to get a world-class auditor. We ended up getting Deloitte. They audit everything we do. And now, because of that foundation, we've received 3 more regulatory approvals, and they were a lot easier. Once you have the first one and the transparency, makes it a lot easier. But the challenge now is education. No one knows that there's a diamond commodity. Everyone thinks that diamonds are controlled by a cartel, that they're inflated. And to some extent that was true, but it's not true anymore. And now it's no different from gold, as it's used for jewelry, it's used for investments, it has some industrial uses. Now diamonds are becoming the same.
How do you, I mean, obviously we're at a conference, so you're telling the story here. How is the story getting out? Organic, I mean, what are you doing? What is Diamond Standard doing to get the story out? Because I will tell you, more and more people are talking about it. And in terms of your appearance on CNBC, we did get a lot of feedback, all positive, by the way, but a lot of people are intrigued by the whole notion of it. I think there's still an intimidation factor around it. Yeah. I think understandably so, but I think more and more people are starting to wrap their heads around it.
Yeah, it's funny. One thing we learned early on, we tried to do advertising. That did not work. Because if you try to advertise, hey, I'm selling you a diamond commodity, and you don't have time to explain, and it's regulated, audited by Deloitte, and here's the correlation, it falls flat because the consumer thinks it's a scam. And they're anti-diamonds because they've had that bad experience where they bought a diamond from a jewelry store and they tried to sell it and they get offered 50 cents on the dollar. So consumer advertising didn't work. The only thing that does work is engaging institutional investors, where we've had a lot of success. But CNBC, the Wall Street Journal sent 5 articles about Diamond Standard. And that's the approach, is speaking to institutional investors, not retail.
Gold has 400-ounce deliverable bars, 100-ounce bars. We talked about those, but there are other, not bars, but you have another one in your pocket as well. Yeah. So this, as I mentioned, I think you said $55,000, and I'll hold this up. I mean, I don't know. Do you trust anybody in this room to sort of walk this around?
Yeah.
Can I sort of?
Absolutely.
So I'm going to get up.
Here, take all 4.
Well, so I want you folks to actually see this. If you can pass it around. Sorry, I'm getting up and moving. This was not part of the equation. But I want people to sort of see this so they can understand it. And I want it back, by the way. Any hoodlums, if any Sicilians out there, I'm going to come for you. But I want you to see it. So talk about, physical delivery and what people are looking for in terms of, listen, in the gold market, there's an end use, right? In diamond market, there's an end use. But you can take delivery of this as well. Speak to that.
So we actually buy these diamonds globally. We built the world's first electronic diamond exchange. And we have 185 members, which are the largest diamond companies in the world. And these are the companies that cut the diamonds, polish them. So we're buying directly from them in India, in Dubai, in Antwerp, in Hong Kong. And then they're inspected by 2 gem labs before we even bid. But then we consolidate them and ship them ourselves through customs. So we're sealing these diamonds at the highest possible we're the first owner of the diamonds. And so basically we're cutting out all these middlemen. And then we assemble these inside the gem lab in New York. We're actually building our 2nd facility right now to have we need a lot more capacity. About 7% of our clients, they want to take delivery. And so we actually ship these to them. There is one challenge though, because these are taxable. So if I ship it to you in New Jersey, you have to pay New Jersey sales tax. So what we built is the first diamond custody vault in partnership with Brinks. We built it in Delaware because there's no sales tax in Delaware. Turns out we built this vault in an economic opportunity zone. So it's kind of a kung fu tax move where there's no sales tax when we deliver. And if you hold your asset in Delaware, in the opportunity zone for 10 years, there's no capital gains tax when you sell it at the end. So you can imagine 90-some% of our clients take delivery in Delaware.
So my sense is, very quickly, you're becoming one of the biggest buyers in the world
Yeah.
of diamonds. Accurate?
We expect to pass $1 billion this year.
And compared to a Tiffany or, as you mentioned, some of the other companies that we've all heard of.
Yeah, giant companies like Tiffany's and Chow Tai Fook, they're much, much larger diamond buyers. But we're on this inflection curve,
Right.
where we're launching multiple funds. We have lots of institutional investors are building positions. We have several RIA firms, and we completed a distribution deal with the largest gold bullion distributor, and they're plugging diamonds into the wealth management platforms and the wirehouses. And so that in the public fund, we expect to really inflect up. Now that's why we're building a new facility.
Talk about the fund. Talk about the Diamond Standard Fund. I mean, you're here, obviously. I don't necessarily, well, talk about it. You can speak more intelligently than I can. Speak about what you're looking for here.
Well, so the first offering was the coin and then the bar. And we have over 4,000 individual accounts where people have been building a position in the spot commodity, and they usually hold it in Delaware. Turns out you cannot hold commodities in an IRA account, for example. You can't, most wealth management firms don't offer commodities to their clients. They need shares. And so one of our partners is Horizon Kinetics, which is a $9 billion fund, a great contrarian investor named Murray Stahl. And with them, we launched a fund called Diamond Standard Fund. It has that vault in Delaware, so it's an opportunity zone fund. And it simply buys coins and bars and turns them into entitled share. And that means we have distribution through brokers. We have third-party marketing. And that's opened up a lot of RIA firms that are now offering that fund to their clients.
Capital appreciation. What moves the market? What moves the diamond market? I think I intuitively understand what moves the gold market, the commodities market. What are the factors out there that's going to make it appreciate in price or depreciate in price?
So the basic is you have supply and demand. And it turns out there's only 7 or 8 actual diamond mining companies. There are names like Rio Tinto, De Beers, Dominion, Lucara. They either own the mine or they own the distribution rights to the mine. And all of them are looking for mines. None of them have found an actual mine in 20 years, as I mentioned. So that supply is the main constraint. The only new source of diamonds that De Beers has found is washed out to sea over millions of years off the tip of Africa. These rivers that run through, and so they'll find diamonds on the seabed. They have 5 ships now. Those 5 total are less than 1/2 of an average mine. So the supply is the main constraint. And as I said, that's falling. And then you have the demand for jewelry, number 1, and that's rising. But really our buying, which is completely unexpected, that is upsetting that. And we think that if you look at gold over the last 20 years, the first gold ETF launched in 2004. That was the State Street GLD. Since then, gold has gone up almost 6x relative to diamonds. So diamonds have actually been flat for 20 years, while gold went up 6x. A lot of it was due to the financialization of gold. You have options, you have ETFs. That's now happening for diamonds. So people ask me, what's the potential upside? It's in multiples like that. It's 4, 5, 6, 7x. Now that will take a while.
Central banks last year bought gold in record amounts, in levels we haven't seen in decades. Is there a central bank play here, or is that just so far-fetched that you don't even think about it?
It could be, but I'll tell you the trend that we've seen, especially since the Russian attack of the Ukraine, where we shut down SWIFT. You have a lot of countries that are thinking twice about holding dollar assets. And the ability to have the asset within their border an asset that's very portable and easily authenticated and can be used to asset back a currency. We've actually been approached by a number of countries that are exploring a central bank asset, but they're these smaller countries. They're not, obviously giant ones.
Competition. Who do you like? What is this? Is it a commodity? Is it a, we can talk about different buckets that it finds itself in. Who do you think competing with is probably the wrong word, but there are only so many dollars to go around. So what asset class is firmly in your purview in terms of taking it away from?
It's interesting. So we see it as complementary to gold. So a lot of our first investors are investors in gold. And they were the natural audience. They understand it. They have a preference for hard assets. They understand the hedge against inflation, the hedge against correlation and volatility aspects. So that's one segment. It's clearly precious metals. Another part of it is digital assets, because inside the coin, there's a wireless computer chip.
Really?
And that chip stores a blockchain token. We have the world's only regulatory license in the world for a commodity token. And what that means is, on the CME, if we deliver 20 of these tokens, that settles the futures contract. So, and all of the data, the only way you know this is fair is that we make the data about every diamond public, and we do that on a blockchain. And that data moves with the asset. So anytime in the future, anyone wants to know what are the diamonds in there, well, it's on the chip, it's on the blockchain. So it's also part digital asset, where our spot market, people just trade that token, so it's extremely liquid. The average has been 50 basis points of spread, that's a big spread for Bitcoin or gold. That's a tiny spread for diamonds. Because if you try to sell a diamond through Sotheby's, right, that's 18% commission. Or if you sell your diamond you bought at a jewelry store, that's 50%. So to have something trade at 50 basis points, 0.5%, is a huge accomplishment.
Institutional adoption was a big part of the Bitcoin story 3-4 years or so ago. Where are you on that sort of timeline?
It's early, so we've met with a lot of pensions and endowments and long-only funds and macro funds, and all of them have been asking us for the same thing, which is a listed product. And so that product is coming. I think it takes about 3 to 6 months before it's live, but we do have approval to launch and list what's called a participation corp, which is simply a corporation that owns coins and bars. And it's very similar to how the uranium funds started up in Canada. So we're following that path. Eventually, we'll have a US ETF, but you need a listed equity in order to get an allocation from most of those large.
That seems to be moving rather quickly for you, though. I mean, yeah, you're on that trajectory. Can you speak to that timeline, or?
We don't have a launch date. We are launching about $350 million in the IPO. We have a syndicate right now of 7 major banks. And we plan to do at-the-market offerings continuously every quarter for the next 5 years or so. But the key point is that because of our regulatory approach, where everything we do is transparent and regulated, it turned out we were welcomed by the regulator of that new product.
Non-correlated assets. Over the last year, obviously, that's taken on important meaning. Talk to me about that.
So, at my years at Tudor, I never saw an asset like this. And part of it's because it's not financialized. But we were able to backtest the diamonds. Once we standardized them, we could backtest it using wholesale data. Over 20 years and over 2 years, diamonds have had a 0.04 correlation to precious metals, gold and silver, 0.05 correlation to stocks and bonds. I've never seen another asset that has 0 correlation to so many things. And since we launched, this has been now live 2 years, the volatility has been about 3.8%, which is half of the commodity indices, for example. Those last year returned 30, 40%, but this returned 30% in its first year, and now it's returned 10%. So it's been positive return with zero correlation and low volatility, and it's a $1.2 trillion asset. So you can imagine an institutional investor is very interested because it's large enough that they can make a meaningful allocation, but it adds to the Sharpe ratio of no matter what they have, low volatility, zero correlation, positive return. It's very attractive.
The growth, we've talked about it last time we spoke, but the growth for this year for Diamond Standard, I think is going to, I hate the term hockey stick, but for lack of a better one, that's sort of what you're looking at. Can you speak to what you foresee over the next year, 18 months?
Yeah, so we delivered 50 million in our first year. We expect this year to be, we expect to pass 1 billion. The facility we're building has capacity for 5 billion of annual production of coins and bars. And that's about the order of magnitude we need to supply the bullion distributor, the public fund, the private fund, the spot market, and the futures market, which are all starting to ramp up now.
In the last minute or so, and I'm going to go out in the crowd and try to retrieve your diamonds, but what do you want the audience to know? Like, what are you excited about moving forward? I mean, I think the world has sort of set up for you to do really well over the next couple of years. I mean, for a long time, lazy won, but lazy no longer exists, I think, and that's going to be important over the next few cycles of investing, for sure.
Yeah, so, the key for us is just making people aware. This new asset is available. It's highly, highly regulated. It's very fair. It's utterly transparent. And it makes this new asset class investable for the very first time in history. That building of positions by so many institutional investors is going to have a significant impact on the price. So it's exactly what we saw with uranium. It's exactly what we saw with gold over 20 years. But uranium, the first uranium funds launched in 2021, and those funds alone doubled the price of uranium just from their demand. Good job.
Dude, you didn't, I know you were worried about that, but you really hit it very well. So Cormac, listen, thank you. I'm really honored to be able to speak to you again. Thanks for joining us. Everybody, thanks for joining us. I'm a stickler for time, and I'm right on my cues, so thanks a lot.
Thank you, Guy. Thank you, everybody.